Module 1, Learning Objective 3, the 4 basic financial statements. And the interesting thing is there are actually 5, but we'll get into that at some future date. Basically, there are 4 financial statements: the balance sheet, the statement of cash flows, the statement of stockholders' equity, and the income statement. And basically, the way these work is that the balance sheet provides you a portrait of the company at a fixed period of time, a fixed point in time, usually the end of the last year, which would be the same as the beginning of this year, December 31st, stroke of midnight. Then the 3 what we call flow statements, the statement of cash flow, statement of stockholders' equity, and income statement, explain what happened during the year. The income statement explains this from a profitability perspective. This is how much profit the company earned during the year, and this is where it came from. Statement of stockholders' equity would explain how stockholders' equity accounts changed during the year. This includes not only profit, which goes to the shareholders, but it also includes dividends, information about dividends, and new stock issuance also. And then the statement of cash flows explains how cash changed, where the cash came from, and where it went. And if you take into account all of these changes, then they'll lead you to the balance sheet at the end of the year. So in essence, the cash flow statement, the stockholders' equity statement, and the income statement link together the balance sheet from the beginning of the year to the end of the year. Now let's talk about each of these financial statements for a moment. The balance sheet reports your financial position, as I said, at a specific point in time. And what it does is it tells you about the assets, liabilities, and stockholders' equity of the company. This is called the accounting equation. Assets equals liabilities plus equity. And the accounting equation must always work. Now, a lot of this is review. If you are an accounting major and you've been taking endless accounting courses, I don't know if you want to watch this or not. You may find it refreshing. I hope there's nothing new here, but you can go with as much of this as you want. Anyway, the balance sheet reports your financial position, and it consists of assets, which is basically what the company has, and we'll go into what some assets are in a moment, and then where those assets came from. And assets could come from 2 different places. It could come from the owners, which is stockholders' equity or equity, or it could come from creditors, which would either be banks or bondholders, and that's what we would call liabilities. So again, stockholders would provide you with your equity, and the liabilities would be the source of debt, of different kinds of loans the company has taken out. So assets, what you own, could come from one of 2 places. It could either come from liabilities or from equity. And again, assets must equal liabilities plus stockholders' equity. If that doesn't equal, that means that you have a mistake somewhere. So here's an example of a balance sheet. This is a simplified balance sheet for Under Armour, and the book uses Under Armour as an example. So you can see here the assets, which is what the company owns. Liabilities, this is money which was borrowed, what we call non-owner financing. And stockholders' equity, which would be the owner financing. And stockholders' equity consists of 3 components. What's called contributed capital. This is money that was invested in the company by the stockholders. Retained earnings is income that was kept in the company. In other words, income that was not distributed as dividends. And other equity is just a miscellaneous kind of area. So investing activities are certain kinds of assets that the company has that will help them make money. And so the process of buying in these assets and perhaps also selling them is called investing activities. And what you would do is you would list your assets in order of liquidity. In other words, cash would be considered the most liquid, and something like goodwill, where you have to sell a whole company in order to get that money back, would be considered the least liquid. So you would list on the balance sheet, you'd start off with cash, then you'd go to more liquid assets like accounts receivable, money your customers owe you, inventory, and then go down to long-lived assets like equipment. And you can see here the proportion of short-term and long-term assets. So some companies are very liquid, like Cisco Systems has a lot of short-term assets, very few long-term assets. Cisco makes internet hardware and networking hardware. Alphabet is Google. You can see Google is very liquid. Whereas something like General Mills, they make cereal, is mostly long-term assets. That is factories and equipment, things like that. Financing activities is where your funding comes from. So again, it could come from owner sources or non-owner sources. Owner sources would be equity. Non-owner sources would be liabilities or debt. And again, owner financing has two components. It really has three. It has resources contributed by the company by its own owners. That's called contributed capital. And profits retained by the company. That's called retained earnings. And here again, you can see the proportion. A company like Home Depot has very high liabilities but very little equity. McDonald's likewise has pretty high liabilities, low equity. Whereas Google has very low debt, or Intel, these high-tech companies, have very little debt and relatively high equity. The income statement provides information about profitability over a period of time. And it's going to really follow a formula of revenues minus expenses. So revenues minus expenses equals net income. Now there's other items in here. There's what's called gains or losses. But the income statement basically provides this information. And we usually think of profitability as a measure of performance. Here's an example of an income statement. The income statement would be revenues minus cost of goods sold. Cost of goods sold is the cost of the sales that you make to customers. So Under Armour, I guess, sells clothing and sporting goods kind of stuff. Revenues would be the money that came in from selling sporting goods and clothing. Cost of goods sold would be how much it costs to make or buy that items that were sold. Gross profit would be the difference. Selling, general, and administrative would be all the other costs of running the business. So sales commission, shipping, advertising, also the cost of paying your managers is all SG&A. If you subtract that, you get income from operations or operating income. Then you may have other items that are kind of financing items like interest expense. And then you have income before taxes. If you then subtract income tax expense, it's usually called provision for income taxes, but it's really income tax expense, and then you get net income. So you have one item here, revenues, at the very top of the screen, and then you have these various expenses which are subtracted from it in arriving at net income. Now the biggest expense item is usually cost of goods sold, and this is how much money the company pays to either make or buy the items that it sells. Selling and general administrative is all the other costs of running the company. They call it here overhead. So salaries, advertising, marketing, rent, IT costs, all the operating costs are considered to be SG&A. So if you take revenues and you subtract expenses, you get net income. And net income measures for you the performance of the company. It's not a perfect measure, but it's a pretty good measure of how well the company is doing. And they have this elaborate explanation here. The ability of companies to create barriers to competitive pressure by patent protection is a key factor. Okay, a lot of things can help you generate income. And what they're saying here is that if you can create a barrier to competition, that'll make you more profitable. And the companies we see here on the left that are the most profitable, that's income divided by percent of sales. I don't know who proofread this, and I apologize. I'm using the canned slides, so you'll have to deal with me. I make some revisions to them later on. Anyway, Apple has a key barrier to competitive pressure, because if you want to use an Apple phone and other Apple and iTunes and all this other stuff, you have to have all Apple products. And once you buy, I have an iPhone here, and I'm kind of stuck with the iPhone because I have a lot of iTunes stuff. So I can never use Android because Apple is everything. So you're kind of like stuck in Apple, and that's it. And you want an Apple, you want to use Apple products, you have to buy an Apple phone. Johnson & Johnson is medication, pharmaceuticals. They get a patent and they're entitled to make these pharmaceuticals without any competition. Likewise, Alphabet is Google, and people use one web search engine, and that is Google. And they use Gmail and other Google products, and it's difficult for other companies to compete with those. So these companies all have a competitive advantage, and that gives them a fairly high net income as a percentage of sales. If you look on the right side here, these are companies without much of a competitive advantage at all. CVS is bricks and mortar local drugstore, and you have a lot of choices there on where you can shop. It's the same thing with Macy's. So their net income as a percentage of sales is relatively low because the barriers to competition are also very low. These companies here are operating in highly competitive environments, whereas these companies have gotten for themselves a certain market niche where there's very little competition. Statement of stockholders' equity explains the changes in stockholders' equity. So the key areas of stockholders' equity again are contributed capital. This would be where stock money is invested in the company by the stockholders, and retained earnings would be income that stayed in the company. In other words, income that was not distributed as dividends. And this would be net income over the life of the company minus all the dividends that were ever paid by the company would be retained earnings. And those were the profits that were kept in the company. And then there's other that we're going to get into later on. So this is kind of what a statement of stockholders' equity will look at. You're going to look at real ones, and you're going to see they're a lot more complicated than this. But you can see here that contributed capital was increased because the company issued stock. Retained earnings was increased by the income during the year, less any dividends. They didn't pay any dividends, and other items. Let's not go there. And other equity also had some other items. But you can see here how statement of stockholders' equity, how these numbers flow from the beginning of the year to the end of the year. And then finally we have this statement of cash flows, and this has three sections: operating, investing, and financing. And that reflects the three areas that we've been talking about in business of operating, investing, and financing. Now, it's not that you can't divide the balance sheet and the income statement into operating, investing, and financing. In fact, what you would find, for example, with the balance sheet, is that short-term assets and long-term assets tend to be operating activities. Long-term assets tend to be investing activities, and long-term liabilities and stockholders' equity are all financing activities. So the balance sheet really does reflect this idea of operating, investing, and financing. Similarly, the income statement does too, because revenues, everything up until income from operations, is operating activities. Interest expense and interest income may reflect investing activities and also financing activities. So the income statement and the balance sheet can also be broken up into these parts. And one of the things that we're going to do in this class is we'll talk about how to break them down to better understand what's going on within a company. And then there's more information. And you don't want to just restrict yourself to the four basic financial statements. Management discussion and analysis is a very important tool to understanding what's going on with the company. So you've got to read that very carefully, and companies will tell you in great detail what's going on. The independent auditor report usually has no information unless there's a problem. And if there's a problem, then that's a very important piece of information. If there's a problem with the company's audit, that may indicate that the information isn't reliable. And therefore, you could stop reading right there and throw everything away, sell the stock, and just get out as quickly as you can. There's the notes to the financial statements. I don't know why, but professors and accountants always call these footnotes, and I've never seen them referred to footnotes. They're not really footnotes, and I've never seen the financial statements ever call them footnotes. They're called notes. But these basically explain specific items in the financial statements and provide you with additional disclosures that you need to know. Then there's all sorts of other filings that companies make that help explain the company's performance, and these are in the SEC. This includes what's called the 8K, and the 8K provides if a new thing happens, let's say a company gets sued or the president of the company resigns, the company would file an 8K with the SEC, and that's important information to have.